What's going on, guys? I just wanted to make a quick video for you guys talking about using higher time frame levels. What I noticed is, I see a lot of traders on the internet using these big picture moves on higher time frame levels, and then going down to smaller time frames to enter them. Because they're going to offer the same risk on the trade, but it's going to offer a lot more reward, right? So, for example, this is a 60-minute time frame. We have these big picture 2 legs down on a 60-minute time frame. And what you'd want to do is you'd want to come in here, have a drawing tool, come to your rectangle, and at this bottom measure move here, just draw an area like this, show on all charts, and have an area just like this. You can even honestly just use this line too at the bottom of this arrow. All charts, apply, and OK. And then when you go to your lower time frame, this might take me some time actually. Let me increase the data series so we can get there. January 12th, I believe it was. Oh, it's loading. Just going to pause the video while this loads 1 second. Cool. All right, so we're back. Everything loaded up. So you can see here this 1 hour, 2 legs down to a measured move. We can trade these on the 2K chart. And it will also help us create directionality because these are pivot points when we get there, right? So now when we're on the 2K chart and we see our prices come down here, we know we can take a long with an immense amount of reward. For example, knowing that we're at this measured move on the hour chart, you might take this long here and hold it until the close of the market, right? If you don't want to do a lot of drawdown, maybe you just go for 3R, right? Maybe you confidently go for 2R, right? Because we're at these higher time frame levels, there's going to be a tremendous amount of support. And surprise, surprise, for the next month, we're extremely bullish after reaching those key levels. But on the, to get into these trades, if you take a higher low, 121 ticks. This is 71 ticks, 53 ticks, a lot of inside bars. Maybe you buy this bull bar, 94 ticks. But to get into these moves here, maybe you take a higher low here, right? 24 ticks. Right, you take a nice bull bar here. Maybe you wait for a first entry pullback, second entry short. It's not the best signal bar, but you can see what I mean here. By these higher time frame levels, offering you trades with great reward. Now, I'm not saying to predict bottoms, but what I'm saying is when you get to these levels, feel more comfortable going for higher reward, right? We have 2 legs down here, right? Measured move here, right? If usually in these areas you go for, 5 points, 6 points, you could be more confident going for 10 points. Why? Because we're at this major area of support, right? Another thing that we can use is introducing Fibs. Is, for example, let's take a look at a fib level here, right? The low, the high, we're expecting a bounce at the 61.8 to 50 area before having a continuation. Now, if we take a look here and we just use our rectangle tool here, we draw this little area here. Let's make this green for support, and we'll have it shown on all charts. Now, obviously, if you didn't know that it was there, you just basically extend it all the way across until it hits that level. And that's a key area of support. It's that 50 to 61.8 area. Now, to get in on this bull bar is almost 80 ticks. That's 20 points. That's $1,000 with one contract, right? But if you go back to the 2000 tick chart, let's go all the way back here. And this was, what day was this? February 13th. All right. We can see here, obviously this would be, extended because we wouldn't know exactly when it would hit. We just know that's a key area. You can see here, we get a little dip right there into this area here, right? And this is a way to go long in these specific areas here, where you can get an immense amount of reward. And again, look how the market takes off after reaching these levels. But finding these higher time frame levels and trading off of them, it's important to know where they're at. One, because they're pivot points. The market's going to change direction at those points, and it's always good to know when and where that's going to happen. But two, they offer great areas to get great reward trades. Right now we have a strong Fibonacci here to here. So based off of this swing here, we know that we'll probably have a Fibonacci level here, right? All charts based off the 1 hour time frame, right? So now if prices go down into this level, we know that this is a pivot point. We might want to be very careful shorting in this area, right? Then we can say, come here, draw another Fibonacci level here. Let's say the low here all the way to the high, right? We have another area of support, in this area here. I'll make this green here, right? If we break through this green box, right? All charts, property, all charts, cool. So now if we're on the 2K tick chart and we break, how far down was this, right? Now if we break through this level, we're probably going to be attacking this level here, right? And we're basically using higher time frames to, one, help us understand directionality better, because we can't see much on these lower time frames. Having these here, know that, hey, there is a pivot point here. Also, this is a 61 zone, so we know that this is a magnet. So if some reason prices start to drop, we know that they most likely want to go to this area here, right? And again, I'll show you guys another example of this. Let's just draw any Fibonacci, right? We get a leg down. Let's say, we're expecting prices to go up here because on a higher time frame, we had one leg pull back, 2 legs to the downside, and we then have an impulse move to the upside, right? So in the hour time frame, we open up our Fibonacci retracement. Let me move this arrow so I can see better. We'll put it at this wick. We'll come all the way to the top here. We now have our 61.8. Again, I like to use a 50 to 61.8. Taking the trade off of the 61 is going to be a little bit more reward. Taking the trade off the 50 is going to ensure that you don't miss pullbacks that only happen to the 50, because the 50 to 61.8 is a sweet spot. But again, it's really up to you. We draw our 51.68 pullback level. Put this to all charts. Now this happened on February 4th. So now if we go to February 4th, right, we now have a pivot point. Now, could you have come in here and drew your retracements like this all the way up here to have this? Of course. But what's the likelihood that you're doing that on the 2000 tick chart? You're not. Nobody does that. It's weird. But on the 1 hour chart, it's very normal because this is a push up. Now on the 2000 tick chart, when you get down to these levels, you're able to, take these trades and know, hey, this is a pivot point. If prices start to come back down, they'll probably reject off this area of support before going up. And again, you can see the move that happened. Obviously, we pulled back down here, but you can see the move that happened and how bullish things were after we rejected in this area. I'll show one more example so you guys have it. Right, let's say we want to see what happens on our next retracement here. Boom. On our next push, what's the likelihood after this push that we pull back? It's going to be this area right here. Let me draw this on the rectangle here. We'll make this green, because green to me is just always support. If we're going short, I just like to make it red. This happened on February 5th. And again, we have another very nice area here where prices reject. And again, could you come in here and draw your tools like this? Of course you can. But again, it's the likelihood of you doing that is very low. You're most likely going to be zoomed in looking for these smaller Fibonacci retracements like this, right? And you can see here we get another 50%, 61.8% rejection. We get a higher low after rejecting on the 50 to 61.8 gold zone, higher low. That's probably a good trade to take for at least 2R. But again, zooming out and looking at a bigger picture, you can see these. And even if you were to go to the daily chart, let's just go to the day chart, delete everything here. All right. I mean, the daily chart is very similar to the 4-hour because you see one leg pullback, 2 legs down, one leg pullback, 2 legs down before going to a new high. So I mean, it's pretty similar to the 1-hour chart that we were using, just a little bit less detail. But yeah, you can see. So for example, here's a good example here. If you go to here, our Fibonacci tool, you can see we reject here off the 50 to 61.80%. Golden area, and this is why I like to have 50% on these higher time frames, because the prices love to reject off these 50 area on higher time frames. And again, if you were to have this drawn as a potential pivot point as to where the bear market would end, let me grab the rectangle here, right? This little area here. You could use a set an alert too, which is a pretty good idea. Actually just popped in my head. Green area here. Now okay, if prices go up, when we get this first leg up, and prices start to come back down, well, this is an area where prices are likely to pivot. And again, this is almost impossible to see on a lower time frame because this is an entire month of data here, over 30 days of data. You would never see this pivot point on a 2K chart. However, if you had your fib levels on this daily and then drew the area where support likely was to happen on the 2K chart, you wouldn't get trapped down here going short. You'd actually begin to get bullish in these particular areas, and you could potentially catch a very big reward trade. Again, this is going to keep you on the right side of the market. It's going to allow you to get higher reward trades and show you likelihood of areas where the market is going to have these pivot points. If you have any other questions, guys, feel free to ask in the Discord, and I'll see you there.